What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome to The Advisor's What's Making Headlines for the week. It's great to have your company. It's been a busy week over here on The Advisor. A lot of headlines and a lot of stories keeping us busy with these capital gains tax and negative gearing changes rolling through the parliament. Lenders reacting and brokers trying to figure out what is going on. But we'll get to all that very soon. I'm joined by our commercial content writer, Ben Squires. How's your week, Ben?
It's been pretty good. It's been pretty flat chat. I think there's been a lot of big stories going on. Yeah, it's just going to be us two today because Annie is up in Queensland at New Broker Academy. So, yeah, we're just going to steer the ship. And
100%. Yeah. And we've got a lot of content to keep us busy, that's for sure. And this week, a lot of kind of updates on the mortgage fraud front, and these ongoing police investigations into this kind of so-called Penthouse Syndicate, that has duped a lot of these banks, chiefly National Australia Bank, into fraudulent loans, and this being kind of professional services set up, and involvement of allegedly bankers and mortgage brokers, and other kind of professional services like accountants and solicitors. So we had a pretty major update on this investigation from New South Wales Police, and that being that New South Wales Police and the New South Wales Crime Commission arrested and alleged that a Sydney broker and former bank manager helped and organised a crime group believed to be the Penthouse Syndicate orchestrate tens of millions of dollars in fraudulent mortgages and business loans. So in the early hours of Tuesday, the detectives from the State Crime Command, assisted by the Raptor Squad, executed a search warrant at an apartment in Wentworth Point in Sydney's west. This was a pretty major announcement made by the police yesterday. There they arrested a 34-year-old man, the business development manager at a major bank, and also a 35-year-old woman who worked as a finance broker as well. Yeah, and investigators, they sort of allege that the man grew on his senior role inside the bank. It's alleged to get these fraudulent deals over the line. Or at least his knowledge of their systems, having been believed to have been allegedly an ex-employee of some major banks. So using, like you said, his kind of prowess and expertise of the bank systems, of their shortcomings and kind of potential vulnerabilities as well to this kind of sophisticated mortgage fraud. And the sums involved is what got me. It's pretty staggering. Single individuals, the banker allegedly obtaining $25 million in property loans secured by mortgages and $6 million in business facilities by approving applications underpinned by false documentation. And the broker allegedly preparing and submitting close to $13 million in loan applications using fabricated or doctored paperwork. They appeared before Burwood Local Court on Wednesday. They were both refused bail. They've been charged with a litany of offences. The banker having been charged with participating in a criminal group and contributing to criminal activity, along with 19 counts of dishonestly obtaining a financial advantage by deception, and the broker as well facing a whole raft of charges here. So really serious allegations, and obviously not good for the broker channel, and also kind of seeing the extent to which, like I said before, this syndicate has been operating is pretty concerning. Yeah, I thought you did a great job reporting on this one. But one of the things you drew out in the story, which was really interesting, is what
investigators sort of explained that it's not just the dollar amount involved in the fraud, but it's the way this sort of system embedded itself within the mainstream finance system.
Yeah.
You know, it's not just relying on fabricated documents. No. It's recruiting or corrupting people at every stage of the lending chain, from front-end brokers to bank staff with sign-off authority. Yeah, it's huge. And it's definitely something, you know, that's captured the industry's attention and hugely concerning.
Yeah, I think so. And, you know, the kind of total sums that police believe are attached to this Penthouse Syndicate are believed to stretch beyond $250 million.
Yeah.
So far, the New South Wales Crime Commission has restrained around $95 million believed to be attached to this fraud scam, being property, cash, cars, luxury items, linked to alleged participants. 25 people apart from these two have been arrested. So this is 27 in total. And like I said before, you've got a range of participants. We had a NAB senior business banking manager arrested in November last year. Then the kind of alleged, believed to have been the ringleader of this scam, was arrested in December of last year. He was also an ex-employee of major banks. And you've had solicitors and accountants that have been involved on this as well. And this is kind of, you know, there's fraud sagas now ongoing, as you said, and kind of hitting the industry. And you've got Austrac doing this fact-finding investigation with the 10 largest lenders and federal authorities, and also credit agencies as well, pulling together information and data, trying to investigate how far this stretches. So it'll be interesting to see how this plays out and continues. But yeah, not good at all to basically see how these, you know, professionals who are kind of meant to have the trust of their clients are now using really sophisticated technology against the banks.
But it shows how vulnerable the system is in a way as well. You know, one of the biggest lending institutions in Australia can sort of get duped by these fraudsters. So it just goes to show you it can happen to anyone, I suppose.
Well, it shouldn't be able to, as you know, major financial institutions. But obviously, we'll keep you updated on this. The police have indicated that this is an ongoing investigation, and none of those alleged participants have entered a plea either. So this is definitely going to be ongoing as it flows through the courts, and these alleged participants, if they make pleas or not, it's all going to go to court and be aired in court as well. So we'll keep our readers up to date with that.
Yeah, that's probably a good tie into our next story, which follows another sort of line of reporting we've had in recent weeks regarding High Money's court case with Finsure.
Yes.
And we wrote about this one on Thursday, but we found out High Money and the major aggregator Finsure have confirmed they have resolved their Supreme Court dispute and mutually agreed to end their sub-aggregation agreement after months of legal proceedings, which was a big update as well. Yeah,
it's big news. Obviously, I've been following this for about a month or so. High Money brought this injunction against Finsure to the New South Wales Supreme Court. They basically argued that it was, you know, unlawfully terminated by Finsure, and I was there in court, and I heard both arguments presented by both sides. It got pretty intense, and it got a little analytical and kind of complex as well. But it was really interesting to see both their arguments here, and Justice Williams approved that interim injunction. She basically freezed the sub-aggregation agreement between the two entities.
Yes.
But she did grant that interim injunction after a couple of days kind of mulling the case. And it was set to go to trial. Now it hasn't. They've kind of come to a mutually agreed resolution. As you said, they've both mutually agreed to terminate the agreement now. So you know, the commercial relationship between Finsure and High Money is over. But yeah, I think it's important to note here that the details of the resolution and the settlement are confidential. They haven't been released. but it was going to continue on to the courts as well. So clearly Finsure and High Money didn't want that to be the case, and they've come to the negotiating table and sorted it out. But this was a really high profile case as well. It attracted a lot of attention, and good reporting from us as well. We had that ruling by the justice, and she really got into the nitty-gritty detail of why she didn't think Finsure made a kind of appropriate argument to oppose the interim injunction. And there were affidavits read in court by senior executives from both High Money and Finsure, and kind of the claims that were made by the lenders and NAB and CBA, ANZ, suspending all of High Money's, eventually suspending all of High Money's broker network, which basically made it kind of impossible to continue doing business, and which is what prompted Finsure to pull out of the agreement. So I really recommend our viewers go and read those stories. And check out the reporting, because there's a lot to it. Yeah, and I think you did a great job sort of summarizing everything that's happened up to this case in the story out on Thursday. So yeah, definitely check that one out. 100%. And keeping on that court train, a pretty big ruling handed down in the middle of the week on Wednesday. So Westpac has been ordered to pay $26 million in civil penalties after the federal court found that the major bank repeatedly failed to properly handle hardship requests from borrowers. This was a 6-year period of missed hardship requests. The court heard that more than 200 requests went unanswered within the time frame, which is 21 days. And in some instances, borrowers received no response at all. So affected customers basically held a range of products from home loans to credit cards to personal loans, and basically told the bank that they couldn't pay back these loans. And ASIC telling the court that, in some instances, customers went weeks without having heard back from the bank, or beyond that legal decision deadline of 21 days, or just simply left in limbo. One of the things in the ruling, Justice McAvoy said, he accepted that the failing stemmed from poor systems rather than an intentional refusal. But you sort of said, that doesn't diminish the seriousness of these things. No. I mean, that's why we've got these kind of laws in place to prevent this very thing from happening. And they take it pretty seriously, because these are vulnerable customers as well. 100%. Sort of at the end of their TEFA. And if they're not sort of getting the right answer from the lenders, they're in serious trouble. So Westpac said that it was justified for it to pay a $10 million fine, and that would be sufficient enough of recognition of wrongdoing. The justice slapped that down. He basically said it would be little more than derisory in the circumstance and therefore wholly inappropriate, and the court instead obviously offered that $26 million penalty to reflect the scale and duration of the breaches and their impact on customers. And it's kind of worth noting as well that Westpac has paid $1.7 million in remediation, including refunds of the fees and interest and compensation for non-financial losses of those customers as well. And we've seen some other cases where similar sort of things have happened. In 2025, NAB and its subsidiary AFSH nominees was hit with a $15.5 million fine after it didn't respond to hardship notices. ANZ faced a $40 million sanction for not properly handling hundreds of hardship requests, and I think non-bank Resimac sort of faced a similar fine as well. So so it's a pattern. It's a track record of the major banks doing this as well. So it's something the regulator's certainly taking seriously. And, I think the banks will be aware of this as well. But it's just a reminder, I think, to sort of. It's hard too when you're operating on such scale. Yes. And servicing, hundreds of thousands of customers. That things get lost in the system or translation. But still, it's inexcusable. I think that's what ASIC was saying as well.
Yeah.
In all circumstances.
Certainly, yeah.
It should be.
And, hopefully it leads to better outcomes and better systems and that kind of
Well,
thing.
I mean, that's why you've got regulators like ASIC to keep them account and bring cases like this forward. But yeah, a pretty major decision there from the federal court.
Yep.
So the federal budget was handed down a couple of weeks ago, and we saw some major changes to investor tax settings, to negative gearing, and to capital gains discounts.
Yeah, we've seen about 10,000 Anthony Albanese AI-generated memes as well.
Yes. Yeah, the fallout has been significant and ongoing.
Yeah.
And it hasn't really showed signs of slowing. You've had all kind of stakeholders, whether it be small business or the tech community, younger Australians, startups, have really been voicing their concerns here about the fact that the capital gains discount amendment, wasn't just included or set on housing alone. It was across basically all assets, whether it be EFTs or shares as well. It's really ruffled some feathers, taxes that businesses pay once they sell their business as well. But we got an update earlier in the week from the government that they would table this legislation in the lower house on Thursday, so getting right to it.
Yep.
And this passed the House yesterday. No surprise that the opposition, the Liberal and National Party, opposed these amendments and changes, but it did pass the House. And Treasurer Chalmers basically said, as he has many times before, that this would overturn more than 2 decades of, he said, quote, a distorted tax system that had fueled property price growth. But it got tense in the lower house yesterday. A lot of interjections, a lot of kind of bills that were put forward by the opposition and also crossbenchers like Allegra Spender to have a lengthy consultation process and inquiry process in the Senate that would last over a couple of months, kind of the opposition wanting to get as many witnesses before that inquiry as possible. They were all voted down. Yeah. When this bill was passed, the Greens basically said in a statement, Party Leader Larissa Waters and Justice spokesperson Nick McKim indicated that a shorter-term inquiry, which will set to conclude on June 22, would be more than sufficient and would provide enough time for the bill to, quote, get the scrutiny that it deserves. That inquiry is a lot shorter than the kind of opposition originally intended, set to conclude by June 22. And then provide, they say, enough time for the legislation to pass Parliament before that winter break on July 2 as well. So more than enough time, about a week and a half, the government ramming this through. And kind of rare as well on a change of this scale for it to be kind of set before the Parliament about a week and a half after it was first announced. And I think what the government's intending to do is to have this first round bill with the big headline changes, and then go back, do that Treasury consultation process with COSBOA and the tech community, the startups, trying to see where the concerns lie and if there are any possible carve-outs, what they'll look like, if there are amendments, exemptions, and then put a more detailed bill to the House later in the year to iron out all the creases. Yeah,
it'll be interesting to see what happens, whether it sort of remains part of the zeitgeist. You get the feeling it's going to.
I think so. I don't think this is getting away from the government anytime soon, but only logically with a change of this scale and magnitude. I think it would have been a little bit naive for them to expect that, the electorate and all of these various stakeholders would take this in a timid fashion.
Yeah, but it's a bold change, and it's not going to make everybody happy, I suppose.
No, and I think the government's pretty unapologetic about that as well. And on the lending front, we've basically seen a flurry of movement from the lenders announcing how these changes to negative gearing are going to impact serviceability calculators. First, we heard from Macquarie a couple of weeks ago, who were the first major lender to put forward an amended serviceability calculator that factored in these negative gearing changes, obviously removing those existing benefits that investors receive on when being serviced for a loan, those negative gearing add-backs that they receive from the banks, and this kind of really having an impact on borrowing capacity as well, and what a borrower's capacity might look like after these changes are removed.
Yes.
Especially, if you own multiple investment properties and you're really utilizing negative gearing, we've seen examples from brokers where the impact is in $400,000-$500,000 reduction in investors' borrowing capacity,
and that's massive. Really,
it's huge. So we heard from NAB earlier this week on Monday. In an email sent to bankers and brokers seen by the advisor, NAB announced, and it should be worth noting here that they were the first of the big four to do this, that they were reshaping how they treated losses from geared properties in its servicing tests, and that it was effectively limiting negative gearing to qualifying new build stock for most fresh investor deals. It has already, it kind of attributed this to the government already naming 12 May as an effective start for this new regime, which is when the budget was handed down. The bank has taken that it's now that is a real factor in a borrower's future cash flow. And the government's real about these reforms. It has the numbers in the lower house. The banks are confident, or at least NAB is, that it'll likely pass Parliament. So there's a lot of detail to this announcement. I think the important thing to stress is that for purchasers, if your sale of contract was signed on or before 12 May, you will still be able to you'll still continue to build in negative gearing benefits into your serviceability, which is noting that grandfathering of the policy, that existing owners of investment properties would still be able to negatively gear. But where a contract is dated after that, and the file reaches unconditional approval by close of business on 26 May, NAB said it would let the decision stand without revisiting the numbers, but if the contract was signed after 12 May, the loan had not cleared approval by 26 May, that it would reassess the application and would only include negative gearing add-backs where it fit its definition of a new build. And NAB obviously set out its definition for a new build as well in its announcement. So I highly encourage our readers to go and look at that as well. We've heard word not just from NAB, we heard word from Connective Horizon, which is the aggregator's white label product funded by Brighton. They also made an update on Monday. They basically said that for new lending like NAB on established investment properties signed before Tuesday, 12 May, it would continue to factor in negative gearing benefits in serviceability calculators for contracts signed after that, where it was a new build, which is that carve-out that the government has made for new investment properties. If you construct or meaningfully add to supply, it would also continue to offer you those add-backs. However, if you purchase an established property after that date, it would no longer be offering those add-backs. And it's not just Connective Horizon. Later in the week, we really did have a kind of consecutive flurry. We had Great Southern Bank, Australian New Zealand Banking Group, ANZ, and we had Suncorp as well, who have all virtually taken the same position as NAB and Macquarie. There's only so much nuance here. As well.
I mean, they're not wasting any time, are they? And no. There's always going to happen this way. But I think it's definitely something for our readers, particularly those who've got heaps of investor clients to be aware of and stay on top of.
100%. And I've written a story today actually about how the kind of the split of opinions among brokers about whether banks should be moving sooner rather than later, or if they should, be holding out until these laws are concretely in place. Some brokers are saying, well, it's created a lot of unnecessary ambiguity for me and my clients, and a lot of uncertainty as well. They're kind of saying that, well, look, if the banks and make announcements sooner, then it would settle a lot of that uncertainty that's now spreading out in the investor class.
That's a really good point too, because as anyone who's tried to sort of buy a property would know, timing is such a crucial element.
Yeah.
And when you've got this other sort of factor, which means before this date, your servicing is one thing, and after this date, your servicing is another thing.
100%.
Then, it's just
you've got
boggling.
other brokers saying that, well, look, there are investors out there that can handle this.
Yeah.
Their drop in borrowing capacity, if they do purchase an existing property after that 12 May date, they've got enough disposable capital there. If they are assessed or applied in one way, and then that's kind of stripped away to enough buffers. Yeah. And they're prepared and willing to go into those deals, and that they'd rather the banks wait until it is law. So there's two split diverging camps here. So I suggest our audience give that one a read.
Oh yeah, definitely.
As well. But we will keep you guys up to date on the movements of the banks. It's really just been a handful so far. This is only about 6-7 banks so far. Yeah. So there's going to be a lot more updates in the next couple of weeks. Certainly now that it's past the lower house, I think we're just going to have a flood of them.
Yep, definitely.
In a short amount of time.
So lots of work on the advisor in the coming weeks.
That's all right. We'll keep you guys updated. Keeping on this federal budget and the fallout from it. Yeah. In an interview midweek, we heard from Commonwealth Bank of Australia CEO Matt Comyn, who shared his views on the budget. I know he said before the budget that he kind of thought, well, he didn't have strong opinions, and basically said that it was a worthy idea to reduce this capital gains discount for investment properties. But what's he said now that the budget's handed down?
Yeah, so appearing on 7:30 this week, Comyn was sort of pressed on whether he supported the move to scrap the 50% capital gains discount and revert to an inflation indexed model. Comyn basically said, and I think this was the rhetoric of a lot of sort of startup founders and small business owners, that the capital gains tax shakeups should stop at property. Yep. Rather than sort of be applied across the whole spectrum of investments. Comyn said, and these are his words, there's a big difference in my mind between sort of passive asset accumulation versus productive capital or risk taking. If I'm just accumulating an asset, I'm passively holding that, versus if I'm investing in a startup, a founder, a business, a junior mining explorer, I think that's quite different. And I don't think we want to change the incentives towards risk and enterprise and innovation. No.
So what he's saying here is that you should only be applied to property.
Yeah.
Got it.
Which is the argument, I guess, I suppose, that a lot of SME owners and startup founders have sort of applied. Yeah. It's tricky one, right? I think it's been, as we sort of said before, it's going to be in the zeitgeist, in the headlines for quite a while.
Yeah. Also on a more kind of detailed front, forecasting the flow-on impacts of these changes. We got more detailed forecasts from some of the major banks, chiefly Westpac, this week as well, modelling how they think the tax shake-up is going to affect volume and composition of investor activity. So the big one from this is they think, combined with the recent and expected interest rate rises and the tax changes, they think there will be a 34% fall in new investor activity in the near term, and that the mix will slowly begin to skew towards new builds.
Yes.
Which is that carve out to continue negative gearing in the budget.
Which is what the sort of changes are intended to do.
Achieve. Which is what you want to hear. And brokers telling me as well that a flooding of inquiries into that new build category in a really short amount of time as well. And they think newly built dwellings are expected to rise 20% to around 40% in absolute terms, despite the fall in total investor activity. That's a lot.
Yes. Yeah.
That is a pretty big skew toward new builds and a shift in the existing pattern.
Yeah, and it was also interesting. So they sort of see dwelling price growth expected to end flat across 2026.
Yeah, they've cut that. And I think by year's end, it'll be down 2.
Yes.
So factoring the rise in the start of the year, it'll be flat. But if you just account for the last 6 months, it'll be a 2% decrease.
Yes.
And I think they've also downgraded their growth forecasts in all the capitals. And Sydney and Melbourne will be ending the year in negative territory at 3% and 4% respectively. And the other mid-tiers will be lower than previously expected. And Brisbane, Perth and Adelaide still growing at quite a large amount.
Perth at 13%.
13%, but lower than I think
than projected,
originally flagged. And also as well that they think this is going to have an impact on supply as well. They think in their longer term projections is over the next couple of years beyond 2026 that this could potentially support the construction of 15 to 30,000 new dwellings a year, and that also the over time the kind of once the market adjusts and the kind of warned that the ability to offset losses across a portfolio may encourage a gradual shift towards larger, more professional landlords.
Okay. Yeah.
So even kind of more sophisticated investors than when we currently have, because the system is so complex as well. A lot of those, existing investors who can still negatively gear, what opportunities lie for them as well to explore the carve-outs in the budget to their favour. I think Westpac thinks that's going to have an impact.
Yeah, it would be interesting to see what happens. But I think you just reading that analysis, you can sort of see how it could play out that way. I think that's sort of fairly fair analysis. So we'll have to wait and see. We
also had the Mortgage and Finance Association of Australia holding a special webinar this week, a members webinar to really investigate the budget. They had a panel of experts there to tell brokers what they were hearing on the ground and how they think brokers should be broaching these changes with their clients. I thought a lot of these were really interesting. Obviously, telling brokers to simplify these budget changes in as much layman terms as possible. But also warning brokers that these shifting lender policies that we spoke about before are probably going to impact borrowing capacity. And so important for brokers to know, which borrower segments might be most exposed as these calculators changed. Also suggesting that landlords and would-be investors, obviously, would need to revisit their overall strategies, including whether to hold or sell certain assets. And they really did stress that where a client used small business entities or a family trust, that brokers need to prompt them to seek specialist tax advice to
sort of figure out the right move.
And I think they've basically said that, look, the timing and valuation issues are important. You've got 1 July 2027 as the commencement date around properties when they should be valued, so this kind of raises questions around when property should be valued or restructured ahead of the new regime. And I'm hearing a lot from brokers as well about conversations they're having about rent vesting and first home buyer pathways as well. The panel kind of said that, well, look, we expect there to be more conversations on those trains of thought. and them saying as well that, modeling after-tax cash flow under different policy assumptions and weighing up whether to refinance or restructure are going to become very frequent topics of conversation with brokers and clients. So mammoth changes are gonna come with a whole raft of implications. And things that'll rear their head as time goes on. This isn't just all of the details being released at one time. You're going to have possible loopholes or niches or details that might of parts and details of the legislation that rear their heads after the fact too. So this is going to be ongoing.
I mean, this is just the start of it. And in your story, you sort of said of the 800 people who were there and polled during the webinar, 82% or 4 in 5 said they were already receiving inquiries from investors. So there's lots of questions out there, lots of borrowers who are sort of confused or maybe just wondering, am I now on the right path with my property portfolio and that kind of thing. But I mean, that really makes the proposition of a broker more valuable than ever.
100%. You've got someone that can really explain these quite complex changes to you and also guide you through the process and what's best for you and navigating that quagmire of amendments to lending policy and serviceability calculators as well. I don't envy the job that brokers do, certainly at a time like this. But yes, it's having an impact, I think, on client conversations and inquiries as well. Brokers telling me inquiries from the investor category are massively down. As all of this ambiguity and uncertainty hangs in the air. So it'll be interesting to see how these changes continue to progress.
100%. And as always with stuff like this, we'll keep reporting and sort of chatting to brokers and let people know what's going on.
For sure. Thank you for joining me this week. It's as always been a lot to talk about and a lot of headlines to process in a very short amount of time.
We did a good job, I think, Charlie.
They creep up on us, these stories. You get to the end of the week and you kind of realize, wow, did I really, really pack all that into 5 days? What felt like a lot more than 5 days.
How's it Friday already?
Exactly. But thanks for joining me on the podcast and thanks to you guys for tuning in. If you do have any stories, tips, or shouts for us at The Advisor or our sister publication, Broker Daily, send us an email and get in touch with us, and we'll be very keen to report on it. Thanks so much for tuning in, and we'll be right back next week. Thanks so much.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.